New today, we're getting a first look at a slew of economic data released by the U.S. government, giving us a clearer picture of the economy following the longest government shutdown in American history.
A lot of significant numbers to go through. Let's go to CNN's Matt Egan, who's in New York. Matt, let's start with the top line of how Americans are feeling about this economy. What does this data show us?
Yeah, Jessica, the new numbers show that the mood on Main Street, it got even darker in November. U.S. consumer confidence unexpectedly fell sharply between October and November, and confidence is dramatically lower than it was at this point last year. And notably, confidence fell really across all political affiliations, Republicans, Democrats, and especially independents. And let's look at the trend here. You can clearly see that consumer confidence is deteriorating in the last few months. In fact, confidence is now at the lowest point since all of the trade war turmoil back in April. Beyond that, you've got to go back to early 2021 for the last time that confidence was this low. And consumers, they say they plan to spend less money. Spending plans fell on everything from appliances and vacations to cars and homes as well. And look, this is a survey, and we know that sometimes people tell pollsters one thing about how they feel about the economy, but they also do something differently when it comes to spending. And that's the most important thing, is actual spending for the economy. But we got some disappointing numbers on that front as well today. This is retail sales delayed for September, delayed by the government shutdown. And what you can see here is a loss of momentum, right? Sales were up, but only barely. In fact, if you adjust for inflation, sales were actually down. So you put it together and you have weakening retail sales and very low consumer confidence. Not a great combination heading into the holiday shopping season.
And also some new inflation numbers came in. Matt, what do they say?
Yeah, we got September producer prices. This is measuring prices before it gets to all of us as consumers. And the big takeaway here was that there was no major alarm bells from these numbers. It showed that producer prices were up by 2.7% year over year. It was flat from the month before. Wall Street investors, economists that I'm talking to, they think that this report was good enough that it'll allow the Federal Reserve to lower interest rates at the next meeting in December. Rate cut odds for that meeting in about 2 weeks. Markets had thought it was kind of a coin flip, right? 50-50 a week ago. But look at this now. 85% chance of an interest rate cut in December. And this is music to the ears of investors on Wall Street, where we see U.S. stocks moving sharply higher today. Back to you.
All right, Matt Egan with the latest there. Thank you so much. Today, key economic data delayed by the government shutdown is pouring in and shedding some new light on the state of the U.S. economy. So first off, U.S. wholesale inflation did heat up between August and September, rising by 0.3%. That was actually as expected. It is an uptick from the prior month, where prices were actually down by 0.1%. A separate report shows retail sales growing more slowly than expected in September as Americans continue to face higher costs. And a new survey shows consumer confidence declining sharply this month to the lowest level since April. And that's when President Trump unveiled his sweeping tariffs. The survey also showing growing pessimism among respondents about job availability and income prospects over the next 6 months. Let's bring in Jerry Storch. He joins us now. He's the former CEO of Toys R Us and former vice chairman of Target. He's currently the CEO of Storch Advisors. Jerry, nice to see you as we get ready for Thanksgiving here and we prepare for Black Friday after that, holiday shopping. We're getting this new economic data. How do you view our current economic status?
Look, there's nothing surprising in any of this data. It's actually quite consistent with what was expected, as you pointed out, and also with the months before. So, you know, the inflation rate is sort of intractable at this high twos, whatever metric you use, 2.5 to 3% inflation, higher than the 2% everybody wants. The retail consumer keeps spending. I mean, this 4.3% increase in retail sales year over year that we saw is actually a pretty good number. So they've been spending throughout all of this. None of that's really the story, though. People talk about, oh, a 10th here, a 10th there, a 10th here, a 10th there. The real problem when you talk to consumers, when you try to understand the problem for policymakers, it's that you have this huge burden from since the pandemic began, where prices have increased in aggregate over 25%. And now you keep adding to that kind of predictably a little bit more than what we want, close to that 3%. And the consumer's going, when do I get a break? And the reality is there's no break coming. It's exactly where it's been for a very long time, and it doesn't seem to be moving very much in any direction. So you don't get to go, even when inflation rate is lower, you don't get anything back from all that increase that you've had over year after year after year after year, including this year.
Yeah, there's a lot of talk about this K-shaped economy. So it kind of goes like this, with the wealthiest in the country continuing to do quite well, getting wealthier, spending at these very high rates, lower income Americans continuing to fare worse, and not spending as much. How much of an impact does that have to our current economic situation, and also what we might see this holiday season?
Sure. First of all, again, if you want to bet against the American consumer during holiday season, you're making a fool's bet. I think it's going to be a pretty good. It's going to be a pretty good season. The credit card data we're seeing, which is real-time data, still shows a growth year over year of 4 to 6% based on who you're talking about. So, and that's what we've seen in the retail sales data, even way back to September, which is what came out today. So I think it's going to be an okay holiday season. There is this difference between the wealthy and the not so wealthy people. I don't think it's a K. People don't like K implies one branch is going up, the other branch is going down. It's more like a tree where branches are growing at different rates. So what you see is the wealthy, they have a lot of extra money. The stock market's on fire, so they're spending on whatever they want. They're doing just great. Now, people who are lower income, they may not have so much of a gain in the stock market. They have to spend more of what they're earning on necessities. So you see food continue to do well. Necessities. You see Walmart doing very well. So necessity, it's not so much fun. But you're still going to buy Christmas presents. It's just not going to be as much fun. It's not going to be as great. And again, more and more just goes to feed the family. And so it's not really a K. Even the lower income segments are still growing. It's kind of interesting. And they may still be growing a little bit more than their wages, but they're not making a lot of progress when inflation is still in this high, 2.5% to 3% range.
And there's also this issue, one metric we like to talk about, gas prices. This gas price discount that from year to year that's been present since President Trump began his second term. And that's been a great, they've really talked about that a lot and have been able to, because that was showing up in the data. But it's now vanished. Again, when you're talking about how people just view the economy, it like kind of in their gut, when gas starts to tick up, how might that impact people's view of their economic situation?
Well, you're right. I mean, gas is very important. And by the way, that was the biggest single contributor to the increase in the producer price index that you were talking about earlier, was the change in gas prices year over year, which is a totally different issue from the tariffs or from anything else going on. But again, I want to emphasize what all this shows is just how difficult this problem is. The intractable nature of it is that you have this huge load of the 25% increase in prices plus continuing gains in other prices. And so it's not going to be enough. Not for the administration, not for policymakers of any sort, to say, well, I've lowered the rate of inflation. The consumer is saying, are you going to lower prices in absolute terms, not the rate of price increase? And the answer, and that's a whole lot harder to do. And that's why you see all this discussion of, rebates or different actions that might actually result in some kind of true savings for consumers, because that's a different kettle of fish from saying I'll lower the pace of increase of what's happening.
And we also saw these consumer confidence levels falling. It's now its lowest level in 7 months since that April announcement of the tariffs by the president. What does that tell you?
Well, there are two things we're in there. One is what we're talking about, this affordability issue, which is obviously becoming more and more center stage. The second here, you got to be a little bit careful. Even the conference board that put up the data today, they said a lot of times that when they did the polling, people were mentioning the government shutdown, which was in place while they're doing some of this polling. So the government shutdown didn't win any friends among the public in general. They thought, my gosh, everybody's all messed up. They can't even come to an agreement on this thing. And so that shot consumer confidence, pretty badly while it's occurring. Now that it's over, I think the consumer is going to forget that and remember the holidays. So I wouldn't put too much of a store in that. But I think the affordability issue is here to stay.
All right, Jerry Storch, good to see you. Thanks so much.
My pleasure.
fighting so long and so hard that they don't know what the they're doing.